Well, I'd like to welcome everyone today to our educational talk. We're excited to draw on the expertise of both Andrew Petersen and the resources of Invesco, one of the world's largest money management firms. A quick note on Andrew. He's a University of Iowa alum, so go Hawks. He's been with Invesco for the last 10 years. He's a certified financial planner, so he understands the issues faced by households pursuing their financial goals, as well as he's a chartered alternative investment analyst. This technical certification helps him to know and explain the investing tools that we use to help our clients. He works with Invesco, who's an American independent investment management company, founded back in 1978, headquartered in Atlanta, Georgia. As of earlier this month, Invesco is managing 1.8 trillion with a T, 1.8 trillion of assets for benefits of individuals, institutions, and governments globally. And now, Andrew, would you like to start off our talk today?
Absolutely. Thank you, David. Thank you, team, for allowing us to get in front of some of your clients. There's certainly no lack of things to talk about right now in the marketplace as we kick off 2025. After a couple of really banner years of really outsized performance in 2023, 2024, we're seeing red numbers for the first time in quite a while. And so I think clients have a lot of questions, concerns, hesitations. So hopefully today is beneficial in that right, addressing some of those objections and really trying to get back to what's important, right? In staying the course and putting some evidence, some historical context behind why we still feel comfortable moving forward, right? And really not letting short-term headlines, short-term knee-jerk reactions, letting our emotions get the best of us and getting back to that long-term financial plan that is specific to us as individuals, as households, as families, all right? So I'm going to touch on really two things today, majority of which is going to focus around the conversation with tariffs. This is a very fluid situation, right? Now, we've done a lot of these type of presentations and educational events the first 4 months of the year. A lot of times what we say today or the updates that happened yesterday are stale in 24 hours. But nonetheless, going to try to give you some evergreen content here to give you some more comfort, to give you some more conviction, no matter what updates we get over the following weeks, months, and even quarters as it resolves around global trade and the current administration's kind of policy take. So first and foremost, we're going to start off real easy here. What is a tariff? Just the basics here. It is a government tax or a duty on imported goods and services from outside of our borders into the United States. All right. Now, there can be certainly good reasons for tariffs to protect certain industries. Think national security in things like military assets, defense, certain technology type patents and intellectual property that can be, closely involved with the physical security of the citizens, the voters, our elected officials here in the United States. Can also regulate trade between different partners, especially if certain partners are, let's call it, being less than fair with how they negotiate some of their trade deals and economics between our companies, their companies, as well as trade between governments. Lastly, it can be a form of government revenue. I would say keep in mind that a lot of times I think we forget on a relative basis, certainly per capita, how wealthy the U.S. is, even compared to other developed nations and compared to even other top 5, top 10 economies in the world. We are the world's consumer. We are relatively, I mean, I know we have our own problems that we still need to solve here at home, and not everybody is as well off as some others. But in general, just in general, we tend to be much wealthier, have a higher standard of living than every other country out there. All right. So again, we are the world's consumer. When you tend to be that much more wealthy relative to others, you tend to buy a heck of a lot more things outside of our borders than maybe that we export. All right. So keep that kind of context in mind as we go through some of these themes. But let's keep moving here. Well, tariffs lead to market volatility. I think that's a foregone conclusion at this point, 4 months into 2025. Now, keep in mind, too, though, that there's a lot of things that result in market volatility. We give you some examples here over the last 10 years, and there's certainly more headlines that you could even highlight as you kind of narrow into this particular graph. But the biggest thing here is uncertainty, right? Especially when we get short-term uncertainty for business decision makers, for boards of directors. If we have this, call it a short-term policy of tariffs on, tariffs off, policy by tweet that we see here in different examples where, gosh, every day, every hour, sometimes seemingly, there's a new update with some major trading partners, with some major countries that we have close ties with when it comes to exchanging goods and services. All right. Now, when business decision makers are not sure what what the outlook is in the next 3, 6, 9, 12 months, they're not sure how many people to hire, or should they freeze hiring? They're not sure on whether they should be stacking up on inventory levels. They're not sure on what their tax liability might be 12 months, 18 months from now. They're not sure which products may have a restriction on what can be exported to countries such as China, for example. That tends to be a big driver of less spending and less business investment, or at least delayed business investment, all right, in terms of volatility. So yes, the more prolonged these tariffs end up, the more widespread tariffs are, yes, the more volatility we should expect, especially in equities moving forward. But nonetheless, short-term volatility should certainly be nothing to fear. That is a constant, if anything, in today's marketplace. So to that point, a lot of us probably feel like, hey, a little out over our skis here. We're seeing single trading days of plus or minus 5, 6, 7%, or even higher earlier here in April, which is pretty dramatic. Is the stock market really like a casino? Sometimes we feel like we're gambling. So let's compare the two. All right, let's draw a line in the sand and make sure that we know the difference. Okay, on the left-hand side, you see your average odds of winning at various kind of floor games in your local casino. You see blackjack, craps, poker, let it ride, baccarat, slots. You notice that none of those are over 50%, right? That's the house advantage. Now, you'll also see Keno at 23%. Now, I know we've all seen, I think, Christmas vacation, Vegas vacation. Folks, we got to stop playing Keno. Even if there's some entertainment value there, that the odds of Keno are just so low that we shouldn't even compare that to other casino games, let alone investing. Now, if you split this graph in half and we compare it to long-term wealth building in the stock market and buying equities, right, that are heavily involved in companies that are for profit, that are going after all of our dollars as consumers, and likewise are influencing breakthroughs in science, in healthcare, in technology, how we communicate with one another, raising that standard of living, right? The longer that you stay invested in U.S. equities, the more likely that you're going to make money, right? There is no comparison here. On the right-hand side, your 1 year, your 3 year, your 5 year. I mean, 10 year, you got a 98% chance of making money, 99.9% chance in the 15 year, right? That is the opposite, that the longer that you sit at the blackjack table, right? The longer that you sit there, it's only a matter of time until you lose money. All right, so is the stock market really like a casino? Very poor comparison, certainly over medium and long-term time horizons. All right, so back to tariffs. How high are tariffs relative to history? Now, most recently, yes, as of Liberation Day, April 2nd, we did add on another 10% of all imports into the U.S., right? Now, there was a lot of other potential reciprocal tariffs and duties that were announced then and then delayed for the next, I would say that'd be about 75 days as we stand here at the end of April, but initially 90 days. So we'll see. Relative to history, yes, we've gotten quite a, I would say, rise in tariffs here most recently. But if you look at the long term, depending on where we land, again, this is a moving target with the current administration and updates that we constantly get from the White House. In particular, we have seen escalation from China, but most recently, it looks like there might be some de-escalation there, in fact, which is kind of similar to what we saw back in 2018 with the kind of U.S.-China trade war that was much more narrow in terms of which economies were targeted and which goods were targeted versus a somewhat blanket approach so far. But again, it looks more like negotiating tactics from the current administration than prolonged everybody's going to be involved in tariffs moving forward. So I think we're making progress, certainly in the short term. But again, I would say expect more volatility moving forward. All right, so can tariffs harm economic activity? When they are one-off or very narrow targeted tariffs to certain industries, to a handful of countries, there's not a great correlation between economic activity going down when tariffs go up. Now, the longer that these sit around, like I said, prolonged tariffs can hurt business investment and spending from businesses as well as from consumers. So what do I mean by that? I mentioned earlier when business decision makers have a tough medium to long-term outlook, that tends to be a wait and see approach. They may be on a hiring freeze. Now, that does have knock-on effects to the end consumer, right? So if certain businesses are laying off workers or on a hiring freeze, well, those employees are probably less incentivized to go make big purchases themselves from an individual or a family standpoint or a household standpoint, right? If my employer just came out with Q1 rhetoric that they're no longer going to be hiring or they're spending down on inventory levels, I'm probably less likely to go out and buy that new truck. Probably less likely to go out and remodel that kitchen that we had plans for, right? So not only do we see potentially reduced business investment, business spending, we could see knock-on effects of reduced consumer spending. Now, those numbers have really not dropped all that much as of yet, as we stand here at the end of April 2025. As soon as we start to see that, though, that absolutely could have broader economic repercussions. The third leg of that stool, even though the numbers haven't shown it quite yet in terms of, call it Trump's first 100 days of his second term, the federal government, in terms of DOGE, in terms of potentially laying off federal workers, it looks like they are interested in less federal spending as well. So all in, could we see things develop where businesses are spending less, consumers are spending less, and yes, even maybe the government, which it's been a long time since the government spent less than what it brought in tax receipts, those three combined could absolutely have a much more pronounced effect on the economy. Now, our base case isn't necessarily a recession, isn't necessarily a huge pullback, but when you get all three of those that are at least saying there's potential pullback or less spending, that is something that we definitely want to monitor moving forward. All right, how about the Federal Reserve and interest rates? Now, will tariffs change their tune? Now, it looked like we were going to be on kind of this slow walk down in terms of interest rates being cut, certainly from the levels that we saw just 6 months ago, right? As we stand today, the Federal Reserve still has a kind of a two-pronged mandate of full employment here in the US, as well as keeping inflation around a 2% target level, right? Now, if tariffs in general, all else equal, which is kind of a funny thing to say in economics because there's so many variables in global commerce today that all else equal really doesn't apply. But if we do see the prices of imported goods come up, and as Americans, we are the world's consumer, theoretically, yes, prices would get passed along, or at least the majority of those price hikes would get passed along to the consumer, to the buyer, right? Now, in general, you would say that, yes, that would be inflationary when the cost of goods go up. Now, when the Fed, does have a couple different tools in their tool belt to address inflation, they could cut interest rates, they could add to their balance sheet in terms of quantitative easing. Now, but you also want to keep employment full, right? So when employers, right, are on a hiring freeze or potential layoffs from the government or private or publicly traded businesses, you kind of have that counteracting balance. So the Fed may be in kind of a tough situation here on whether they need to raise rates to combat inflation or lower them to keep employment full. So kind of a catch-22. We'll see where the legislation lands. We'll see where the policy lands from our elected officials and the administration. But I would not put a ton of reliability in terms of, do tariffs equal correlation, causation to the Fed changing their decisions? Probably not. You're probably certainly not going to hear their rhetoric as direct as that. All right. But again, certainly something that the Fed is monitoring in terms of jobs, unemployment, the labor force, as well as seemingly something that they're probably more afraid of is uncontrolled inflation. But it looks like we're a long ways from that, at least compared to, call it 2 summers ago. All right, so will tariffs close the U.S. budget gap? In general, duties, revenues taken in from taxes on imported goods is relatively minimal compared to other versions of receipts that our federal government takes in. Now, if you raise tariffs, yeah, theoretically revenues should go up, but that also assumes that demand stays the same, right? If the U.S. consumer is hesitant to make major purchases or major investments because the cost of things are going up, net revenues may not change all that much. All right. Again, so if you have to spend more on gas, on groceries, on fuel, on housing, on clothing that we import from around the world, that's less money that you have in your pocket to spend on other things, such as paying down debt, such as investing, etc. So just kind of giving you more context here than anything. There are a handful of different bullet points that the White House has come out with in terms of why we're changing our policy on tariffs. One of those was increasing revenues for the U.S. government. That's a balancing act, right? Because again, demand can certainly change when prices go up. All right. Last but not least here, and then I think I have one more graphic for you before I'll turn things back over to our hosts at Precept. Will tariffs kill the equity bull market? So we give you here in the middle an example of what we saw in 2018. All right. Now, in terms of U.S. stocks, see if we can highlight this here. The calendar year, yes, was slightly negative, but if you look at the kind of the peak, the previous high going into 2018 to the low, that was close to a 20% drawdown in the S&P 500. Now, we didn't quite see that yet so far in 2025. We did see that for tech stocks, if you're going to narrow down the sector, right? And some of those high flyers that had done so well previously, think the Mag 7, the Teslas, the Googles, the Microsofts, the NVIDIAs of the world certainly have had pullbacks of at least 20% for most of those stocks. But nonetheless, if you stayed the course, if you had at least a medium to long-term outlook and stayed patient, right? Amongst the headlines with tariffs, the US-China trade war, we'll see what happens over the next 6, 12, 18 months. If you stayed the course 3 years after those 2018 headlines and certainly higher levels of uncertainty, you certainly got paid for it. You got rewarded for it with very outsized returns for US stocks in the years following, 2020, 2021, with roughly 17.6% in annualized performance. So oftentimes, the opportunity cost of being partially invested or having kind of one foot in, one foot out, waiting for the storm clouds to clear can be quite expensive because a lot of times the stock market recovers a lot faster than maybe we're willing to get back into the marketplace. So patience is definitely rewarded a lot of times, especially when it pertains to politics, when it pertains to legislation, when it pertains to trying to guess where interest rates are going. That is such a difficult call to get correct. Invesco is certainly not in that business of trading on some of those short-term uncertainties, short-term headlines. And I would certainly imagine that the Precept team and your wealth planners here on this call today are probably not in that business most of the time themselves. Last but not least, I do like this just for further context, especially when we start to see maybe some red numbers in our portfolios for Q1, for example. Now, as we stand today, the U.S. stock market is honestly not down all that much relative to what you should expect on a calendar year basis, maybe 5-6% as we stand here on April 30th, year to date down for the S&P 500. But in past examples, just to give you a barometer, a measuring stick of how scary some of these pullbacks, drawdowns, bear markets may be, since World War II, so post-World War II, for the last, call it 80 years now, drawdowns of 5 to 10%, we kind of mark that as a teddy bear kind of pullback, happens almost every other year, right? Very, very common. 43 times since 1945. What is the average time to recovery from a 5 to 10% pullback? Just about 90 days, right? Now, that is an incredibly short-term time horizon, right? 90 days. Everybody should be able to weather that storm. Even a 10 to 20% pullback, as painful on paper as that can be visually with some of those numbers, right? 10 to 20%. Doesn't happen nearly as often as a 5 to 10% pullback. We did see that in the NASDAQ. We did see that in the tech sector already this year. But again, as far as how long do I need to wait when I see that kind of pullback on average to where I get back to break even? A little over 8 months, all right? Again, a very, very short time window, I think, relative to maybe what we would have in our heads or what we would assume. I'll go one more rung down this ladder where you get to a brown bear, minus 20 to minus 30%. Again, it doesn't happen very often. Average time to recovery, a little over 2 years. I would say even all retirees as we stand today, your typical 65-year-old, 70-year-old, we are planning for multi-decade retirements. A little over 2 years of market recovery for our stock portfolio is certainly manageable, right? Is certainly manageable and relatively speaking, still a very short-term time horizon when we're talking stocks, when we're talking equity. So I hope that's a little bit of a reassuring note when we continue to see volatility, when we continue to see some pretty noticeable swings on a day-to-day basis, on a week-to-week basis. Nonetheless, if we can try to zoom out as much as possible, we're typically in a good spot over the long term. All right, so I'm going to finish there. I don't know if we have any questions, but certainly happy to stick around if we do. I'm going to stop sharing my screen here and hand things back to our team at Precept.
David, you look like you're about to jump on a question.
Okay.
Oh,
He's
Andrew, can you
ready.
see?
you type yours. I was going to ask mine. Go ahead and read yours, David.
Can you see the comments, Andrew?
I'm taking a look at them now. I see one question here. Yeah, sure. How has preparing for possible tariffs affected recent earnings announcements? I think in pretty much every call that you're going to see in publicly traded companies, especially in the S&P 500, they're going to mention tariffs several times. There's been a handful of companies out there that actually have gone with two different predictions for earnings depending on which way that the tariff policy falls. As I mentioned in some of the graphics that we showed, kind of this policy by tweet really makes it difficult for business decision makers to have any confidence, any conviction in major research and development, reinvestment back in their businesses, hiring, extending operations overseas. I think they truly do have to have this kind of wait and see approach. Nonetheless, though, in general, earnings are holding up fairly well, even after 2 years of above average, to say the least, earnings. If we start to see some cracks in the consumer, which we're really not flashing red at this point, some of those telltale signs would be fixed income or bond spreads start to widen, where lenders are asking for higher interest rates for borrowers. We're not seeing a ton of that. If anything, the 10-year Treasury continues to kind of trod downwards. We're not seeing a ton of defaults on auto loans or mortgages, starting to creep up a little bit relative to the last couple of years, but again, far from flashing red. I think if we do see consumer spending go down, even though we've seen sentiment go down a lot, in terms of the level of spending has been very, very consistent. It's been very, very consistent, even over the last 4 or 5 months. So it's kind of more watch what consumers do, not necessarily what they say or how they survey results, which is interesting. But those are some of the things that we have our eye on as it relates to, hey, what are the chances of recession? We're still not overly concerned of that, just because a lot of these companies do continue to have incredibly outsized earnings, especially those top 5, those top 10 names, a lot of which are associated with U.S. tech. But I think that's just reassuring that you continue to see after they pay their employees, after the cost of goods sold, after they pay their taxes, after they pay the interest on their debts, a lot of these companies are still taking in 10 billion, 50 billion, 100 billion. If you're talking the Amazons of the world, the Googles, the NVIDIAs, the Metas, you still have some of the most robust balance sheets in the world with, that are weighted the heaviest and the most common indices here at home that a lot of our clients have exposure to and should continue to have conviction with.
Okay, thank you.
So Andrew, a lot of times when clients get anxious about what they're seeing in the media, what they're hearing on the news, a lot of times it's more localized, okay, because we're observant of what's around us. Okay. So, gas prices go up here in the Houston area, but yet gas prices are already high in California. So, how do you get that relative? But, looking at like the national market for houses, and I was trying to explain this to a client yesterday that yes, the housing market, we have seen an increase in inventories above the normal summertime pop that usually happens. And then, with interest rates coming down, but then you have Chevron here in Houston, okay, big Chevron, that announced layoff. Well, that's localized, but yet we're seeing jobs, the jobs report, is coming out strong. Unemployment is still low. If we're looking at localized versus national, and like you're saying, we're not overly concerned about the recession word right now. the media wants to take each one of those little aspects and say, oh, well, this is going to be, this is a recession indicator. Could you like just give a little vote of confidence, a little bit more about, understanding what is local versus national, and why Invesco looks at it's not just national, it's global. This is, this is the talk of the town. If we're not having a tariff, we have a government shutdown for a balanced budget. If we're not having a government shutdown for a balanced budget, we have something else, because we've got to have something, some kind of drama in the government.
Right. And I think a lot of times that negative headline is what sells, is what gets eyeballs, unfortunately. And there's always going to be reasons on why not to be fully invested, or why to pull back, why to be risk off. And again, a lot of times the opportunity cost of doing that can have some pretty influential effects over a retirement portfolio, certainly over the long term. We do have a couple pieces that even talk about like missing some of the best days in the marketplace can have these outsized effects on where your nest egg is 10, 20, 30 years down the road. I think one graphic in particular talks about even missing just like 10 of the best days in the US stock market can almost cut your return in half. Now, those 10 best days do tend to be alongside some of the most volatile and worst days. So, that is an extreme example. But I kind of always go back to remember what you can control and what affects your household specifically. Like all these headlines that you see around MSNBC, Bloomberg, all the media outlets with kind of the event of the day. Does that really directly affect ourselves as individuals, as families, as households? Does that affect our personal portfolios and where our individual goals are, whether that's short, medium, or long term? Once you put that filter in place, is like, how does this affect me? What's important to me? How much money do I need and when? I would say 99.9% of most things that you're going to see that come across as, news that you need to act on probably doesn't matter, right? Probably doesn't matter for an individual situation. Now, the localized stuff, I think, is material just because it's so much closer to home. And those are storylines that are certainly very relatable. But nonetheless, I mean, I think especially some of those broader economic trends, they tend to affect everyone, even though it's a lot of times it's slower moving than maybe some of those local headlines. But again, I would say just focus on the situation that you have at hand, what matters to you and the people that you care about, and then control what you can, right? We can control how often we save, right? How early, what's our timeline? Like the longer that we have money in the marketplace, whether it's stocks, bonds, alternatives, real estate, we can directly control how long we're in the markets. We can affect how much we save, right? But what everybody wants to focus on and they have the least control over is what's my rate of return, right? So if we can focus on the first two instead of a huge amount of attention on the last one, your rate of return, typically your rate of return will figure things out for itself. If you can invest for the long term, if you can have a savings goal that matches, some of those long-term numbers that makes you feel comfortable of having a content or a sustainable retirement. So a lot of it's noise. Hopefully today you saw some graphics, some historical context that give you at least a measuring stick and some evidence on why to stay the course instead of just us telling you, hey, stay patient. I know that's sometimes you need a little bit more reassurance than that. But it's a valid question, right? Like there's always reasons to be concerned, to be partially invested. But hopefully today's call does at least help it, make you feel a little bit more included in your own financial plan and kind of journey to where you want to be.
Thank you very much.
Oh, Dave, got another question.
Oh, look, another question popped up.
We see here, U.S. market, S&P 500 has outpaced non-U.S. for a decade. Any outlook that would significantly change that pattern? Yes, this is a popular one, right? Like we've seen kind of this line of American exceptionalism, certainly for a long time now, especially with U.S. tech. As far as how Invesco views that, we're starting to see international, whether it's kind of Europe and in emerging markets, yes, they're certainly outperforming the US so far here in 2025.
Yeah.
I would caveat that though with a lot of that, it does pertain to the US tech sector. Like if you take that out, you see a lot different numbers as far as total return. In general though, too, if you look back I think why a lot of folks continue to have conviction in the US stock market, keep in mind as well, the S&P 500 gets roughly 40% of its revenues from outside of our borders. So even though, yes, those 500 names in the US stock market are domiciled here at home, they do almost half their business. Half their consumers are outside of our borders. All right. So that S&P 500, those US stocks are maybe even much more diversified than you might even think. So keep that in mind. That's kind of one caveat to that story. Secondarily, here in the US, we have a lot of tailwinds and a lot of natural advantages that even other countries don't, such as pretty darn reliable electoral system and democracy, a pretty darn reliable judicial system and justice system, all right? Pretty darn reliable property rights, where you're not seeing the government very often come in saying, hey, this was yours, now it's ours, right? That you might see in countries like Russia or China that don't have some of the benefits of those property rights. We have the world's reserve currency, the deepest stock and bond markets in the world in terms of size. This world's strongest military, arguably still. So you combine a lot of those together, and that continues to give a lot of advantages as to why not only should ourselves be very comfortable and continuing to invest in US stocks, but also international investors. That is a huge reason why they bring a lot of their cash, their investments to our shores. All right. There's very few countries that can claim even a couple of those examples as to why we continue to lead. Now, outside of that, just as far as some of those bigger names that you see in the S&P 500 or the NASDAQ, again, incredibly profitable, incredibly competitive, and they tend to go out and hire the best talent in terms of workforce internationally. That is how they keep their edge, right? These are very different companies than even in the early 2000s, where looking at the tech sector again, where if you just had a .com behind your name, you were kind of rewarded for it, at least for several years there leading up to 2001. Very different dynamic today. Most of these companies have 5, 6, 7 different streams of revenue, incredibly profitable, not just with revenue, but they have earnings, right? And they also tend to buy up a lot of their competition that tends to be additive to their existing business models and tend to be entrenched. And whether it's in communication services, whether it's in semiconductors, robotics, satellites, self-driving cars, Internet of Things, where all our devices are connected. If you had to pick one sector that is changing the way every other sector does business, technology would probably be the first, right?
Yeah.
And we have a natural advantage, at least historically. Now, there's certainly different countries and economies that are catching up or right behind us in terms of technology that tend to, I would say, copy a lot of the ways that we do businesses. But nonetheless, I think that natural advantage that started on the West Coast, but it's kind of everywhere now here in the United States with tech, is going to continue to lead a lot of our industries moving forward. So do we see a huge sea change as far as international now way outperforming the US? Not necessarily. I think you want to own both, right? To have some balance. When certain markets sell off, having maybe a little dry powder to add when markets go down, I think is a great idea too. But nonetheless, do we inherently have less conviction with US stocks just because we've seen a pullback year to date? Not at all.
Okay. Yeah, I appreciate that because I know, over the last 90, 120 days, investing overseas seems to have been has generated better short-term reward. But I just think the fundamentals that you talked about, the rule of law, the property rights issues, allow technology to flourish or innovation to flourish. And, that's looking in the rearview mirror, that's been a good thing. And looking forward, I don't see Europe changing to at this point to make it a better place for investor dollars.
Yeah.
Agreed. And there's certain, don't get me wrong, there's certainly some amazing companies to invest in outside the US's borders, but just in terms of the quantity and the reliability, whether it's politically, whether it's from a property rights standpoint, whether it's from just elected officials that can be unreliable or voted out of office a lot sooner than expected or a lot more frequent than here in the US. Like there's just a heck of a lot more consistency here at home. But yes, that's maybe why you hire an active manager that specializes in European stocks or stocks in Africa or stocks in emerging markets such as China, South Korea. I mean, you name it. So that typically having a specialty there, having boots on the ground where physically have offices in some of those more nuanced countries can go a long ways in navigating, hey, what do we like long term? What do we want to make sure that we avoid with some of those more nuanced and specific markets?
Okay, thank you.
Bet.
Kyle, you have anything else?
No, I don't.
Okay. Well, Andrew, thank you so much. I know personally, like I know I got a lot out of this, especially just, reminding everyone that we can only control what we can control, and so just remember what your specific goals and needs are, and just make sure you're communicating that with us. If anything is changing in your life, make sure that we are abreast of that so that way we can, make the right plans for you, because, nothing is one size fits all, because it all depends on what your particular situation is. So don't let the news get you, to be panicking and make decisions. I personally watch the only news I need to, and that's it. I do try not to stay off a lot of that extra stuff because all they're wanting to do is tell you the negative because otherwise happy news is not entertaining. So again, thank you so much. We really appreciate this. And as always, reach out to us for any extra questions so that we can help you along the way. So thank you, Andrew.
Hey, you bet. Thanks, Lindsay. Thanks,
All
David.
right.
See you.